Is Taiwan Semiconductor Manufacturing a buy now? We're performing a TSM stock analysis using the Select 6 analysis. We'll be looking at the most telling financial metrics before we estimate not one but two fair intrinsic values for TSM. You'll want to watch till the end of the video when we give our rating to the company. Along the way, there's going to be a key bonus metric that just might be the tipping point when analyzing Taiwan Semiconductor for your portfolio. Before we get into these valuable metrics, how has TSM stock performed? Right now, Taiwan Semiconductor stock trades for $91.07 per share. Year to date, they're beating the market. Their stock price is up 21.5%, while the S&P 500 is up 13.5%. Warren Buffett made an investment into the company last year, which he's since exited. From their lows around Buffett's investment, TSM stock is up 60%. In the last decade, they've been one of the top performing stocks in the market. They're compounding at 17.5%, easily beating the S&P 500 over this time. When we go way back before the global financial crisis, in the last 18.5 years, TSM is compounding at 14% annually. That crushes the market over this time. Keep in mind, right now they pay a 1.57% dividend yield. Their average yield over this time is added to their returns. TSM trades $20 below their 52-week high. They're up $30 from their 52-week low. One of the largest businesses in the world, Taiwan Semiconductor has a market cap of $439 billion. But the burning question is, why should we be paying close attention to Taiwan Semiconductor? Taiwan Semiconductor Manufacturing is the world's largest dedicated chip foundry with almost 60% market share. TSMC was founded in 1987 as a joint venture of Philips, the government of Taiwan, and private investors. It went public as an ADR in the United States in 1997. TSMC's scale and high-quality technology allow the firm to generate solid operating margins, even in the highly competitive foundry business. Furthermore, the shift to the fabless business model has created tailwinds for TSMC. The foundry leader has an illustrious customer base, including Apple, AMD, and NVIDIA. It looks to apply cutting-edge process technologies to its semiconductor designs. TSMC employs more than 73,000 people. Now let's dive deep into their financials. We'll start with metric number 1, where we want their average return on capital in the last 5 years to be above 14%. A typical business earns a 7% return on capital. By looking for a benchmark that's double this, we can build in margin of safety based on the quality of the company. TSMC earns stable, above average returns in all 5 of these years. They've even increased in recent years. These have come in above 20% across this time. They earned 29% returns on capital in their last year. When these are averaged out, TSMC earns 24% average returns on capital in a given year. That's 3.5 times better than a typical business. This is a huge check on metric number 1. Metric number 2, we want growth to support these high returns on capital. We're looking for revenue, net income, and free cash flow growth. This metric's all or nothing. We need these all to be up, and we'll include today's numbers. In this time, TSMC has more than doubled their revenues. Their earnings are up 2.5 times. Today, their free cash flows are up just 13% from where they were at in 2018. This is still growth, even though the company has recently increased their capital expenditures by quite a bit as they're building out new fabs. They've also included some changes in inventory and accounts payable, and a charge in their other operating activities. Those are all things to be mindful of. Their CapEx makes the biggest difference over this time. Again, they've still grown their free cash flows. Much of their capital expenditures are for growth as they're building new fabs across the globe. This complements the majority of their operations, which are based in Taiwan. This growth means it's a check on metric number 2. Metric number 3, we're looking at the business from the view of an individual shareholder. We want to see earnings per share growth. We just learned TSMC's net incomes, aka their earnings, have grown by 2.5 times. The company's also just bought back a marginal amount of shares, meaning their earnings are really going to drive this growth. With the big increase in their earnings per share are up. This is another check on metric number 3. Taiwan Semiconductor is perfect to start. Metric number 4, we want to see free cash flow per share growth. A similar situation here. Their free cash flows have grown while they bought back just a marginal amount of shares. It's another check as they've grown their free cash flows per share. To recap so far, Taiwan Semiconductor is a perfect 4 for 4 on our analysis. Before we look at the company's balance sheet and then get into our fair value estimates, why don't we check in on our bonus? Right now, TSM pays a 1.57% dividend yield, but is it safe? That's what we're trying to figure out in our bonus, where we want this to be supported. Taiwan Semiconductor has grown their dividends over this time. At the same time, they've also grown their free cash flows. They've supported their dividends using their free cash flows in 3 of these last 5 years. These were supported in their most recent fiscal year. They're also supported today, which is what we want to see. This is a check on our bonus. In recessions, it's businesses with too much debt that can have the biggest losses, go bankrupt, or even fail. Metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. TSM is in a very healthy financial position. They've had negative net debt in all 5 of the last years. This means they're left over with cash after paying off their debts. At the same time, they've also generated free cash flow in all 5 years. This has even grown. Today, they have $17 billion in cash left over on their balance sheet after paying off their debts. They've also generated $51.8 billion of free cash flow in their last 5 fiscal years. It's a great financial position to be in. This is a check on metric number 5. Flawless through our first 5 metrics, does Taiwan Semiconductor have what it takes to be a perfect Select 6 stock? Let's find out. The big metric of them all, metric number 6, we want TSMC's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we'll use their free cash flows to estimate their fair intrinsic value. Right now, TSM has a $413 billion enterprise value. It looks at the company similar to it being a private business by taking into account both its market cap and its net debt position. We learned in the last 5 years, they produced $51.8 billion of free cash flow. This means in an average year, they produce $10.4 billion of free cash flow. When we divide that by their enterprise value, it gives us a 2.5% average free cash flow to enterprise value yield. On a current basis, they produce $9.5 billion of free cash flow in their last 12 months. When that's divided by their enterprise value, it gives us a 2.2% current free cash flow to enterprise value yield. These both come in below the yield from the 10-year treasury. They're only about half of the risk premium we're looking for. This means coming in all the way on metric number 6, this is our first and only X of the day for TSMC. Don't just throw the business out. You'll want to keep watching as we estimate their fair value per share and give our rating. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze TSMC. This takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We'll start with an average of their free cash flows in their last 3 fiscal years, then use historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for the business. TSMC has been a highly predictable company in their past. This better informs these assumptions, yet it's no guarantee for the future. If we assume they grow their average free cash flows by 16% annually in the next decade, then in the following decade, we'll assume that these grow at 8% annually. We'll add in their tangible book value to give an estimate of their net worth. If we want a return of 15% annually, which beats the market and it's what Warren Buffett looks for from his investments, at today's valuation multiples, an estimate of TSMC's fair value per share is around $65. That's potentially right in line with the prices Warren Buffett himself was buying into the company at just last year. Keep some key points in mind. Buffett again has sold out of his position. There are still a lot of super investors in the company. These include big names like Stephen Mandel, David Roth, the Sequoia Fund, David Loeb, and David Tepper. There were 2 big recent ads to the company, both by David Loeb and David Tepper. It's definitely a business super investors are following closely. TSM trades for a price to owner earnings ratio of 17 times, which is just below their median of 18 times in the last decade. Their stock is up more than 50% from where Buffett was buying into the company, where he was paying below 13 times price to owner earnings. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll talk through our rating for TSM, but we need to address something first. We've covered the numbers, but their qualitative factors may be even more important. Why don't we learn what these are? Let's look at a long thesis for the business. Number 1, TSMC should consistently earn higher gross margins than competitors thanks to its economies of scale and premium pricing justified by cutting-edge process technologies. Number 2, TSMC wins when customers compete to offer the most advanced processing systems using the latest process technologies. Number 3, TSMC will benefit from more semiconductor firms embracing the fabless business model and internet giants designing their own data center chips. But we'd be remiss if we didn't cover the negatives of the business as well. Let's look at a short thesis. Number 1, although TSMC is the foundry leader, each generation of process technology matures and commoditizes quickly, potentially forcing the company to deal with pricing pressure. Number 2, TSMC's new approach to diversifying production geographically may add cost pressures while in the short run doing little to add resilience to stability. Number 3, Samsung and Intel are committed to heavy capital spending under the support of the US government. SMIC and other state-supported Chinese foundries also lurk as potential threats. Those are some of their qualitative factors. Now let's combine those with their financials as we give our rating. So far, we learned TSM checks 5 of our 6 boxes on the Select 6 analysis. They also check out on our bonus. The company earns high returns on capital, they've grown, they've kept their shares pretty much flat, they have a cash position on their balance sheet. Those are all signs of being a wonderful business, but they look off when we're evaluating them on a free cash flow basis to their enterprise value. Not surprising, they've increased in price since Warren Buffett bought into the business. Again, he exited his position in early 2023. He revealed in his set of interviews in Japan that this was largely out of geopolitical concerns, not necessarily out of concern for the company itself. In many aspects, Taiwan Semiconductor has a similar business profile to the BNSF Railroad, with high capital requirements but very stable margins, and potentially a long runway for growth, as many other companies in the world rely on it. Keep in mind this isn't financial advice. When we looked at our discounted cash flow analysis from today's valuation multiples, if you believe those assumptions and you want a market-beating 15% rate of return, an estimate for TSM stock price is around $65. Down from today's current prices, but in line where Warren Buffett was buying into the business. When we add in our qualitative factors, TSMC looks like an excellent candidate for more research. If you enjoyed our TSM stock analysis, like the video and subscribe to the channel for more.